Liquidity is not important to financial markets. It is everything to financial markets. And signs have recently begun to appear that liquidity is drying up. One sign is in the repo market, which is giving people flashbacks of September 2019, because the overnight repo rate hit 5.54% at the end of November, which is abnormally high, and it looks like it is still struggling to come back down to normal levels. Meanwhile, the SOFR, the secured overnight financing rate, hit a record high of 5.39%. Cracks are starting to form in the foundation of the economy. But why is this important? Why is this happening? And what does it mean for you? Let's take a short trip back in time to the great financial crisis so that we can see where this whole thing started. Most people are unaware, but when Lehman Brothers failed, that was actually a liquidity issue. Lehman did as all financial institutions do pretty much every night. They went to the overnight funding markets and tried to get cash, and nobody would give it to them. Just like how pawn shops work, overnight banks will take their collateral, they'll sell it to another bank, and they'll say, I promise to repurchase that collateral from you at a point in the future. Lehman offered the standard collateral, which at the time was mortgage-backed securities. But suddenly, nobody was willing to accept mortgage-backed securities anymore. As a result, overnight, Lehman was insolvent. They were not able to get the cash they needed for the next day. Even worse, everybody had the exact same collateral, mortgage-backed securities. And so within a very short amount of time, every single financial institution would have toppled over at the same fate as Lehman. So the Federal Reserve stepped in and they became the counterparty. They injected the cash and took that bad collateral so that everybody could get the cash they needed. So when you see the cost of overnight cash start to increase rapidly and without warning, this is what you should be reminded of. This is why it's a problem. Not a single financial institution in the world can exist without easy and cheap access to overnight cash. And as the reserves in the financial system dwindle down, the access to that liquidity becomes more expensive as liquidity gets more scarce by the day. So why is this starting to show up again right now? Well, there are two reasons. And the first is that the Federal Reserve is doing the same thing they were doing last time we saw problems appear in overnight funding markets. And that thing is quantitative tightening, or QT. QT is the exact opposite of QE, quantitative easing, and most people are aware of what QE is. QE is the process where the Federal Reserve prints money and purchases assets from financial markets. Mostly today, that's going to be US Treasuries. And they are purchasing these treasuries from banks. As the Fed buys these treasuries from the open market, the banks that sell the treasuries to the Fed get this cash. And then with that cash, they're able to do anything they want. And usually they just turn around and buy more treasuries. This process increases the money supply, and it increases both the absolute level of liquidity in the system and the ratio of liquidity relative to the amount of collateral in the system, because the Fed is injecting dollars into the system while withdrawing treasuries or assets or collateral from the system. So there's more reserves, more liquidity, more cash, less collateral, less assets, less treasuries. Now, for everybody who loves to get technical, we need a quick note of nuance. Quantitative easing does not directly influence or control the actual money supply, M2. In other words, bank deposits, like your dollars in your bank account. Instead, it increases the base layer of money, or in other words, bank reserves. Those increased bank reserves then give banks the ability to lend money into existence, which then increases M2, or all of the dollars in bank accounts like your deposits in your bank account. This nuance matters because all the quantitative easing that happened after the financial crisis did not result in any significant spike in the actual money supply. In contrast, the quantitative easing that took place in 2020 and 2021 absolutely had a massive impact on the actual money supply. So QE lays the foundation for the capability for more money in circulation. It just does not directly cause it. But for banks, that base money, those reserves, is liquidity. So at this point, we're not worried about M2 or dollars deposits that are in circulation. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where iTrust Capital comes in. iTrust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, iTrust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. So that's QE, which means that QT, quantitative tightening, is the exact opposite. QT is the process by which the Federal Reserve's balance sheet actually falls. This is the Federal Reserve's balance sheet, and you can see in 2008 it increased in 2011 with another round of QE, it increased in 12 and 2013 and 2014 with another round of QE, and also increased in 2020 and 2021 with more QE. Quantitative tightening, on the other hand, is the reverse. First round of quantitative tightening started in 2018 and went into 2019, and the next round of quantitative tightening started in 2022 and continued through 2023. Now, if the Fed's balance sheet growing increases liquidity in the financial system, then it stands to reason that the Fed's balance sheet falling will decrease liquidity in the financial system. That's because the mechanics, again, are directly opposite to what happens during QE. During QE, the Fed prints money and buys assets, and so they're taking assets out of the financial marketplace and they're inserting cash. Quantitative tightening is the opposite. Those assets that the Fed bought are debt. Debt gets paid off, which means that as those treasuries mature, dollars are getting paid to the Federal Reserve and they are ceasing to be in circulation. They literally cease to exist. When the Federal Reserve is engaging in quantitative tightening, they don't even have to do this passively by just letting debt get paid off. They can be even more aggressive and actually sell debt back onto the marketplace. But either way, dollars are leaving circulation, making liquidity more scarce. This is both true in absolute terms and the ratio, the relative amount of liquidity relative to the amount of assets or collateral in the system. Now, during 2018 and 2019, when the Federal Reserve was engaging in quantitative tightening, obviously liquidity was becoming more and more scarce during that time. This blew up in the face of financial markets in September of 2019. In September of 2019, suddenly everybody needed cash, but nobody had cash. It just wasn't available. The repo market blew up, overnight cash markets became extremely expensive, and then the Fed had to intervene again. They did this by returning to quantitative easing. As you can see, their balance sheet started to rise again, reversing the QT from before, injecting new cash into the system, buying assets out of the system. Now, the Federal Reserve is only one piece of this puzzle. There is a second reason why this is happening right now, and that has to do with government borrowing. Let's go back to 2018 and 2019 yet again. This is a chart of the federal surplus or deficit. When the blue line is above the zero black line, the federal government is running a surplus. That means they are taking more dollars in taxes than they are spending. But for most of US government's history, the blue line is below the black line, which means they are spending more than they're taxing. So they have to make up that difference with borrowing, adding to the national debt. That amount every year is called the deficit. Now, most people, especially on the right, have no idea, but President Trump was actually blowing the deficit up. You can see this trend from when Obama left office. The deficit got worse and worse every single year to the point in 2019, before COVID happened and all the COVID spending, the deficit exceeded $1 trillion in 2019. That was the largest deficit since 2012. So it's important to recognize that while the Federal Reserve was engaging in quantitative tightening and reducing liquidity, the federal government was also borrowing rapidly more and more. Now, when the federal government borrows money, they do that by selling a bond. It is a treasury bond. We just call those treasuries. It's very simply an IOU, like all bonds are. This IOU says that I will pay you a certain number of dollars on a certain date with a certain amount of interest on top. I sell that to you by you paying me dollars for that, and then I use those dollars that you paid me to spend on whatever I want as the government. And then at a future date when that IOU matures, I pay you back the dollars that I promised. As the government increases its borrowing, or in other words, the deficit gets worse, these IOUs flood the system. And when increased borrowing happens at the exact same time as the Federal Reserve is tightening, you get liquidity issues. Fewer dollars in circulation while there's an increasing demand for these dollars. Both of these things happened in 2018 and 2019. And both of these things are happening again today. Taking a look at the Federal Reserve's balance sheet, ever since May of 2022, the Fed's balance sheet has been declining. Following 2020, the federal deficit was on track to improve every year, but starting in 2023, the deficit actually started to get worse again, totaling 1.7 trillion in 2023. Looking at the totals, both of these things, increased government borrowing and Fed's quantitative tightening, are happening at a pace they've never happened at together before. And when these things happen, the market reacts extremely poorly. Take, for instance, the taper tantrum that happened at the end of 2018, where the stock market fell over 20%. And the only thing that stopped this market collapse was the Federal Reserve promised to stop raising interest rates, and the market started expecting future cuts. And the time before that, when we experienced liquidity issues, was the Great Financial Crisis, in which the stock market fell 57% from top to bottom. And given the secured overnight financing rate recently hitting an all-time high of 5.39%, and the repo rate staying abnormally elevated recently, we are starting to see cracks appear. Now, don't get me wrong, these are not canyons showing up. These are simply hairline cracks. But still, they are signs that conditions are worsening. Not signs that it's going to blow up tomorrow, but over the next year or so, we are very likely to start seeing consequences. Now, as a side note, but this is an important side note, all of these issues would be gone with a central bank digital currency. Overnight funding, cash markets would cease to exist if all money was held on one centrally controlled, unified ledger at the central bank. Your dollars would simply be an entry on the ledger at the central bank, the Fed, not a liability at a private bank. All transactions would simply be recorded internally, like changing the numbers in a spreadsheet. No overnight cash markets, no matching assets and liabilities, no collateral issues, no settlement issues between banks. Let me be clear, I am absolutely not advocating for a CBDC. I'm actually doing the exact opposite. I've always been extremely and vocally against CBDCs. CBDCs are a tyrant's wet dream. So I say this to expose their plan, because if and when something catastrophic happens again in overnight funding markets, a central bank digital currency will very likely be proposed as the solution. And the terrible part is that they'll be right. A CBDC will fix this. The only problem is that it will cause far greater harm for freedom, prosperity, privacy, and individual financial sovereignty. And if you don't have a way to transact and exchange outside of the financial system before you need it, you won't be able to get it once you do. If you'd like help learning how to protect yourself from their financial tyranny and how to protect your portfolio from the systemic risk of markets blowing up because of their constant and disastrous intervention, then I invite you to become a member of Heresy Financial University. In less than 1 month, the price is going to be going up permanently, which means that December is your last chance to get 2023 pricing. If you use code LASTCHANCE2023, you'll become a member at a 67% discount compared to what it will cost starting just next month. You'll be grandfathered in forever, and it will never be available at this price again. If you're interested, link is below. As always, thank you so much for watching. Have a great day.